Hi, good afternoon, everybody. We'll just wait for a couple of more minutes for more participants to join in. We'll start at around 12:10 IST. Thank you. Hi, good afternoon, good morning. Thank you for joining in on a Saturday. So we will cover looking back at the year 2024. So there's a lot of data that I've put on this particular presentation. So I might go a little fast. If you want me to go through a particular slide and you want some more in-depth conversations to take place for that particular thing, please do put it in the end, saying that yes, this is something that I want to go through again. So we will do that. So it's in three parts. One is global, one is India, and the other one is Neo. Right. So we'll cover how Neo has been doing, what Neo can do, all these scenarios. Looking forward to 2025. Right. Okay. So let's look back. Globalization is now in its phase of deglobalization. This is a trend that you've been hearing for a long time. It's not just 1 year, but this is you're seeing it in complete effect, right? We went from easing to tightening, and now next year we are already looking towards easing, right? This is what has happened in the last 1 2 years, right? Where it was zero and then drastic increase in rates, and now we are seeing some bit of easing that is taking place, right? We went from a zero interest rate to high interest rate, which is it's a very problematic scenario for the world because it leads to sticky inflation. Right? When you have sticky inflation, it gets very difficult for you to bring down that particular inflation. Hence, the higher interest rates. Right now, you are looking at cuts in interest rates because there's a cool down sort of scenario. And does that cool down sort of scenario look more like a slowdown or look more like a recession? So yes, GDP numbers also that have been coming in seem to be on the healthier side, but they are staring at a very deep slowdown when it comes to global growth. Right, this is across the world. Right, so we look at a lot of data. So if you look at what's been happening, you see Fed's balance sheet uh, expanded. You look at from the pandemic all the way up to raging inflation, and now you are having this sort of where the balance sheet is shrinking, right? You see, but anytime there's a shrink, you see there are many issues over issues over issues. So we had the SVB crisis. We had then there was after that we saw a possible crisis that can come up in the US banking side, a larger one. So you saw more tightening taking place, and you look at what's been happening on the fund rate. You see at this point since 2015 up until now there's been a drastic jump in our rates, and what they're saying is that the target rate would somewhere be between 4.2 4.25 to 4.5. The upcoming meeting is on 17th, so we will know how much of whether after Trump coming in, whether there is a cut that has to take place, how large of a cut that has to take place, what is the pace of the cut. All of that will become very clear after the Fed meet. Right, but this is what has happened. You look at the Fed's balance sheet, and all of this has led into uh, more and more problems for the world. Right. So if you look at money growth, and that is suggesting more benign inflation environment, right? If you see the jump, right, 19 all the way up until 21, right? Inflation has been extremely high. And even now, this just looks from a YOY perspective, but when you see from a longer term chart perspective, it remains very, very sticky at that point. Right. So right now, the latest print was somewhere around 2.3, 2.4%. But nonetheless, this number is looking to be quite high from historical levels and its fundamental levels. Right. Now, what happens when a rate cut usually takes place, right? And the US economy avoids a recession. These are possibilities. It's not that this has happened over history, but that doesn't mean that this is the most likely scenario. It just means that it is a possibility. Usually, what happens is you look at it with the recession, you see commodities and equities taking a very big hit. You see the dollar also weakening. Uh, but you see bonds sort of do it. So what's been happening now is that you're seeing there's a sell-off even on the bond market, where rates went from 3.75 in the US to 4 point, I think 4.45. Why all of this is very important is because the bond market is always forward than the equity market, right? So bond markets are already pricing in sticky inflation and more inflationary environment for the world, given the policies that are coming from the Trump administration, right? But if you look at it from without recession bond, what usually happens, right? You see rates come down, not as much, but with the recession, we see there's a cut. Commodities start doing well, equities start doing well, high yield, whatever, basically risky assets, risky and riskier assets start doing very well when things look rosy good. So you know what can do when things look rosy good. You know what we have to do when things look not that great. Right? Uh, Now, this is very important for non-resident Indians, right? Your dollar, right? Over the last uh, 2 weeks, you've seen a rally on the dollar side, right? And when you saw that rally on the dollar side, for the last 5 days, you saw more and more news coming out about weakening currencies in China, weakening currencies in India, weakening currencies in Japan, weakening currencies in Australia. Right? Now that is very, very important because going forward, you will only see more and more currency wars taking place to make that particular country more competitive. Okay. So naturally, if the US is going to talk about how they have to make America great again and more capacity addition, more infrastructure development growth, more money coming into physical assets, there naturally the US dollar has to be very competitive. Right? So right now there has been some strength, but for them to be competitive to other countries, they cannot remain at that particular differential, right? So you expect a lot of volatility to take place on the currency side, right? Which can lead to more and more issues on the fundamentals of certain countries. Fundamentals. So for India specific, you will not have that much of an issue because I think on all fronts, right, on the macro front, we are scoring very, very well, very, very well compared to our history. But you expect globally, right, that other developing nations and other developed nations, particularly in the Europe, will face a problem if US continues to remain strong. So expect a lot of volatility on the currency side. Right now, what happens when the Fed starts lowering rates? Because that seems to be a lot in focus and has been in focus for the last 2 years. If you see, whenever the Fed has cut uh, interest rates, your quality growth starts to outperform low quality cyclicals, right? You saw riskier assets. Which part of risky assets are doing very well? Your quality companies start doing extremely well. Now, this is not a trend only in the US. Now, when you have fundamentals in India where larger companies have delevered for the last 3 years, right? ROCs are high. Their appetite to put in money into growth areas is high. Naturally, quality is the only part that can take advantage of more and more opportunities because fundamentally they are looking very, very strong. Right. So this is a trend that you see across the world where front end rates decelerate and then you see quality start doing very, very well compared to its low quality segments. This is a trend all across the world. So quality is one way where we are concentrating on even on the new side, and you will see that how we have our particular thinking tank and how we go about investing for you. Right. Now, this is a worrisome trend. Right, large cap growth is at its highest versus small cap value in the US. So US today now is around 20 to 23% of the world market cap, right? Which is again at an all-time high. Right? That is being led by the Max 7. But more and more money is only going towards these parts of the market. And you can see that from a price relative basis, you're seeing large caps again and again outperforming the small cap, and a lot of money keeps going into the large cap growth parts because they are the ones investing. They are the ones who are actually going out, taking on risk, and making more and more money on it. The last time we saw this trend was somewhere in the 2000 era, right? Which again proved to be a very big bubble. Like so, there can be a possibility that we are entering into a bubble phase. Thing with bubbles is you don't know how long it lasts, you don't know how big it can get, and you don't know, when it will burst also. Right? So you don't know. But from the data, you can see from a behavioral perspective, what are people doing? They're willing to pay more and more and more for incremental growth. Right? Wherever they're able to find growth, they are willing to pay more and more. And that is a trend. And that has led to this, where the Max 7 now dominates S&P 500. Is almost 30% of the entire market. right? And we've seen this trend in India before, where a couple of houses, where a couple of stocks commanded a big market share, even on the Nifty 50 and on Sensex, right? So there is some very, very big polarization that is taking place, and this is a worrisome trend, right? More and more money going to the same place, which means naturally from a as a stock picker, right, you would see that no, it's becoming more and more consensus driven. So the opportunity lies more in contrarian ideas. Across the world, it lies more in bottom up contrarian ideas, right? Now, if you see, we were talking about bubbles, and this AI bubble is bigger than the 1990s tech bubble. Because if you see top 10 somewhere, they were trading at somewhere around 24 times. Today, the forward is just for the top, is somewhere around 27 times. Right. So you are seeing that there are signs of a bubble, but it's not as big of a bubble. And we don't know how long it is going to go on for. The third thing, you don't know when it will burst. Right? That's the thing with bubbles. You can see from a behavioral perspective as to what's been happening, and there are correlations to the past, right? Again, on the equity side, versus the rest of the world, US performance has been phenomenal. Right, last time internet bubble was somewhere at median. 1966 Nifty 50 bubble was +1 standard. But if you see now, performance has been rock solid and has continuously been outperforming. But I have not put this data here, but I will put out that question across the world. How much percentage of companies or how much percentage of market cap has actually outperformed the Max 7. Right? You can put whatever answer you have in the chat box, but the question is across the world, how much percentage of companies have actually gone and beaten the Max 7? Right? And from which country also? That also you can put. Right? Now, if you see from a growth perspective is that it's above consensus. If you see across the world, right? If you see US, the expectation is that yes, there would be some sort of revival. Europe and UK, they are not. So basically, the entire part of Europe doesn't seem to still show signs of big recovery. So there's a lot of policy change that has to happen in that particular part. China, for that matter, we don't know what the numbers will be, but the consensus remains the same that yes, you would see some bit of growth, but the consensus does go about saying that US would show some sort of recovery, and emerging markets again would show strong growth. But that again depends on currency. Right? Again, global growth comes forefront to what is going to happen on the currency side. And if things don't look really good on the currency side, then you might see a very big problem on global growth. Right. So now looking ahead, what are the scenarios that can, all of this is public data, nothing is calculated, all of this is public. We also take decisions based on what we are seeing and what information we are getting. And information outside is huge. Now information has become very, very accessible. So everything is public data. Now, if you see here, are AI, so let's take a question. Are AI valuations ahead of us, ahead of fundamental, right? You say yes, and if there is high rates and a hard landing, stocks will take a hit, bonds will take a hit. If you see US corporate growth is doing well, where the growth models but profits remain very strong, then yes, naturally you would see, from a risk perspective, on the shorter term side, equity to do well, but bonds not doing well. So bonds are always forward. So they would show that yes, there will be issues that can come in uh, long into the future, right? So the 10-year would react already to it, right? So there are different scenarios here. Now look at, will there be a recession in the next 12 months, right? You say no, then there is easing supply constraints, boost growth. So now this is completely different, right? Today you're seeing tariffs being put, so you supply would become a very big problem. Again, it's more inflationary. So the possibility of this happening, of no recession happening in the next 12 months, is somewhat lower. But what would happen if none of no tariff hikes, supply chain issues start getting better, naturally you would see everything starting to do very well, right? There would be, you know, uh, good returns coming in on a corporate profitability side as well, and naturally that would lead into stock markets and bond market doing well. However, nothing happens, then again inflation will fall below target. Central bank will deliver deeper rate cuts, faster rate cuts, deeper rate cuts just to bail everybody out. That would not be good for the entire economy. Right. So if you look at it from a scenario perspective, uh, depends again, very hard to say, but depends completely on currency and what policy. So January when he comes, you would know what is going to take place and how things are going to take place, and what 2025 looks for. Look how 2025 looks for India, China, and other developing nations, right? But from a scenario perspective, if things do well, then you're good. But what the assumption that we are going to go with is that this policy is going to be very inflation in nature. That's what everybody is assuming. And by that logic, you would see some problem coming in on both the macro front and on the micro front. Right. So we are very well prepared for that. So opportunity, taking advantage of opportunities for you, is should start setting up the minute he enters and takes the role of the president, where yes, you would take advantage of any opportunity that comes to you uh, from a fall in prices perspective, right? And the other part is very important, gold. Like in this scenario of currency war, you need to have an alternate currency. We are having an alternate currency on the precious metal side, and anytime you see Fed rates going down where there's easing, you do see that there's a very big rally on the gold. So there's a repricing always on the gold front, right? On precious metals, there's a very big repricing, right? So we are, and in this cycle, right, when the rates did go up, gold still relatively remained very strong. It was not as volatile as what it was assumed to be or expected to be. Right? So in this cycle, there's a complete disconnect. Even when dollar strengthened, gold reacted for a couple of days. But after that, immediately it jumped back to where it was. So there is a lot of activity that's been happening on the gold side, and the demand that is coming in is from central banks. Right? So it's very sticky demand. Uh, so the rebasement of precious metals is a very big possibility, and we are of the belief that yes, you would have very big performance coming in this particular cycle, 10 years, 12 years down, right? So Neo does take advantage of other asset classes, and this happens to be a very core part of our allocation. Right. Now let's look at India. Right. What's happening on India? If you look at it just from a USD perspective, right? In terms of USD dollar, India has done very well. India has done phenomenally well in terms of performance this year, where the benchmark indices are somewhere around 18%. If you see in local currency, it's 19, so the effect is not very high. So even when you invest in India, you're not losing out on in terms of currency, right? So because the RBI has been able to manage currency really well uh, in this cycle, so they've done a phenomenal job. And you see that equity returns in USD terms also has been very strong for India. Right. If you look at it from a China perspective or a UK or Japan, other developing nations and developed nations, you see it's doing very right. So local currency and US currency both are showing very strong strength. They've performed extremely well. Right. Our India market has surged 55% to reach 5.7 trillion USD. Right. So our market cap has increased by 22%. So we do command a very big chunk in global uh, in the global market cap as well. So now there's a lot of news that comes in that FIIs are driving flows, FIIs are doing this. No, it's DIIs who've been buying most of the money. But look at this in terms of charts, FII flow in India is reaching, it's somewhere around its low standard deviation, which means that yeah, it has always been cyclical. It will always be cyclical. Money will come in, money will go out. Doesn't matter. The volatility used to be very high back then, but the volatility now is not very high for one single reason is that we as domestic investors and retail investors have been buying and have been putting more and more money into our stock market. So if you see from a net equity invested by domestic mutual funds as a percentage of market cap, which is the dark blue line, uh, You look at it, it's again quite high. Right. So we have look at the jump. We have been supporting our domestic market. So the volatility that used to be there in terms of foreign investors is very low. Right. So we have been very strong in terms of outflows, and any fall in the market is being bought very aggressively by retail and domestic institutional investors. So basically, what it means that as a money manager, our active management and timing becomes very critical. That's one thing. Second, we have to, when the time comes for us to buy high quality businesses, right? So you see the trend shows that yes, you need to buy high quality businesses, and we have been buying high quality businesses since 2022. Since our inception, that was the entire thesis, that we want more and more of high quality business. We want to be ahead of consensus. And consensus now is going more towards high quality because value in India has done phenomenally well, right? So at that point, the research and the level of work that we have to do for that particular business that we want to own needs to be very high. And second, we, as we get an opportunity, our position size needs to be very accurate. So if we want to buy a certain amount of percentage, say X percentage or 5% in a particular business, at that time, how much can we go to and make sure that we are very well adequated for this particular idea, knowing all the risks that are being priced in. Right. So as money managers, our game just gets stepped up. Right. And Neo has been able to step up its game since its inception. And you see further on as to how Neo has been able to do it. Right. So if you see, retail has been a very big support. So don't worry too much about FIIs. Retail has been participating drastically. Right. Now, if you look at India's GDP, latest print shows that it is low, but our projected rates have been somewhere around 6.5 to 7%, and that is achievable from an India perspective, given that our fundamentals on the macro front are very good, and that corporate profitability is expected to increase and do very well. Like stable growth is what we are assuming and going with. So, but if you look at the trend of what's been happening, we have been somewhere around 6.5, 6.2, something like that. And only this quarter has shown a seasonal downturn. But second half, as budget comes in and the government wants to start talking about spending, you will see that there will be some bit of, we are going with the assumption that it should be 6.5 to 7%. Right. And if you see from a gross value add contribution also, construction, that is infrastructure, has been the major driver for our growth. And that's a good thing because we are coming off. Uh, so we last spent between 2000 to 2010. Now in this particular cycle, we are spending money. So there was a big wave of consumption driven growth. Now it's more from a gross fixed capital formation sort of growth, right? Now, if you look at our EPS, so this is what is sort of the driver, right? So if you look at our EPS, our projected EPS for 2 years is somewhere around 1200 rupees. So by that logic, we are somewhere between 20 times, 21 times, which is not bad, which is not very expensive, but it's not very cheap. So we are paying a premium for that particular growth, right? Because India is the only country that is showing that level of growth across the world. We are paying that particular premium for that growth, right? But where we need to pay that premium is why active fund managers and why we need to work with advisors and anybody, right? Anybody on the active fund manager side, because they are going to place you where there is growth by not paying too much, and that is what Neo can sort of do for you, right? If you see from a capex point, if you see previous cycle, we have crossed the level for previous cycle, right? We've been investing continuously now, and our plan is that for the next couple of years till 2030, there's good pipeline of spending to take place from the government to create newer assets that can be revenue generating for us and increase our income levels, right? So we are on that phase of infrastructure growth that leads into consumption driven growth for India. That's why you see so much of comparison that takes place between China and India, and China did this and India did this. Yeah, they are two separate. China was very aggressive, but I think we are very fiscally prudent. Our tax numbers are very strong. So we are being very fiscally prudent in terms of spending money. So you expect that yes, India does show very strong growth for the next 10 years, both in terms of infrastructure and in terms of consumption. Right. So all of these signs, right? Now look at this cash flow from operations to capex, right? It's low, which means that there is enough cash flow that they can use for new investments, and this is private, right? So we will show, from a private perspective, the spending that has to happen has majorly been from uh, public sector and government-owned companies, and that has to shift more to private. So when the confidence starts coming in on a larger scale, you would see private also starting to uh, participate more in terms of infrastructure development. Now, if you see from a earnings growth, this is slightly dated, but if you see, there has been some sort of a slowdown in terms of earnings growth for BSE 500. Right? This quarter has been slow. Expect the next quarter also to show slight recovery, but still, on a 5Y basis, still to be slow. But if you see, where is this slowdown actually sort of coming from? So managements during their earnings update have indicated that urban consumers are cutting back on this is a newspaper article, right? It's from Financial Express. It's a newspaper article, so it's the same information that you and I have, right? So managements during their earnings update have indicated that urban consumers are cutting back on spending across various categories, including essentials like food and personal care, as well as discretionary items due to economic uncertainties and most important, rising costs of living. So inflation is hurting us. uh, in conclusion, the notable downgrades in earnings forecast in India can be attributed to several factors, which is weak consumer demand, cyclical economic conditions, decreased government spending, and adverse weather. So it's a seasonal thing, but that doesn't mean that from an inflation perspective, it's easy on us. No, it's not very easy, which means that the growth continuously needs to be there, right? So India can provide that level of growth to us as well as the world. As you say, fundamentals are very, very strong, and private capex also is low, which means that the public sector has been driving, and now private has ample space to start driving. Right. So where is this slowdown actually coming from? And this is where we have sort of been very, very picky on and choosy on in terms of what businesses we want in the mid and small cap space. Right. So if you see, expectations for this space has always been high. Right. So from a bottom line number, you see that it has been below, right? Below expectation. And if you see from a large cap side, which is where we are looking to do these, because these are all high quality companies. That doesn't mean you won't get high quality companies in mid and small, but from a larger perspective, uh, things are looking very, very good on that front, right? Mid and small still show weakness. They have not meet expectation, so we are being very picky and choosy in terms of which business we want to buy. Right? But overall, the quarter has been weak. We expect it's a seasonal thing. We expect as spending starts going up, things would again start reviving and things will start looking better. Better, not as great, better. Right. Now, will private capex revive? So if you see how much of private capex has been happening, 5.8 trillion rupees, 8.6, and it's very low, right? So you are seeing that it's very range bound. It's been within that 6 to 8. You saw last 2 years that they are spending, but they're not spending in a very big way. And wherever the capex has actually been coming in, has been coming in on power, telecom, and oil and petroleum. So it's still not broad based. It's coming, but it's still not broad based. So for broad based to start coming in, there's a lot of confidence that has to get built up yet, which would take a year, year and a half or so as we start showing promising growth, and as projects start getting executed and those projects actually start delivering very good returns, you would see a broad-based addition in terms of capacity from private players, right? But right now it has been coming only from certain parts of corporate India. You would see a broad-based sort of trend coming in as results keep coming out. Right. Now let's look at valuation. Like I said, it's somewhere around 20, 21 times, which is not very cheap, not very, very expensive, but not very cheap. But if you look at it in terms of the risk spread, mid and smalls look completely unattractive. And this we've been saying for some time since our inception, that our allocation towards mid and smalls will be very precise, we will be very picky, and we have been very picky in terms of what we want to do. We would rather do this than take risk on. Yeah, we would rather do this than take very high risk in terms of earning growth, given that the macro environment is also not as conducive to take riskier bets, right? So we would rather do this since we have a multi-asset approach. We have no cap on any particular asset class. We would rather do that than to take a extremely broad-based call on small and mids. Though we have exposure to small and mids, but we are being very picky, right? So from a valuation perspective, we know that where the growth is coming from, we want to be very active in terms of position sizing and the businesses that we want to buy. Right. If you see from an earnings perspective, prefer stocks with less gap between PE and earnings growth, which means that you see there are parts of the market that are very strong. There are parts of the market that have very, very large intrinsic value where fundamentally we can take advantage of. So universe is large. There's not no problem in terms of what we can buy. Just that sometimes we won't get that price for which we are very active in terms of how much we want to scale up, and our active allocation to that particular business becomes very high, right? So let's look at mutual fund flows, right? Because this is very important. This has been the driver of returns for small and mid caps for the last 3 years, right? If you see from small and mid cap perspective, 2022, 2023, and 2024 has been stellar years in terms of flows. If you see 3,800, 19,000, 41,000, so net flows have been very, very large. So you see on the flip, right? What has consensus been doing? They've been moving out of high quality, large cap oriented funds. So retail, basically the domestic institutions are not getting a lot of money on the large cap front, which is why you see very benign performance coming in from that front. But this year onwards, you're seeing a shift where people are moving towards safety. You cannot have stocks in your portfolio where it drops 50%, which is what small and mid caps have done now in the last 2 months, where certain companies have peaked, have dropped 50% from their peak. Right. So we do not want to take that risk for you, and we won't take that level of risk unless and until we get very cheap valuation on certain businesses. Right. So if you see from a risk perspective, right? So we saw a chart in which usually there is this assumption that sectoral and thematic funds are risky in nature. And when things start to do very well, investors' risk appetite starts to go up, and you see a big chunk going into sectoral and thematic funds. A lot of money has been flowing in into sectoral and thematic funds. See, this just gives us an idea of where the money is going in the market and whether we want to do this or not. This is one chart that we look at to see, okay, where can we take a contrarian approach in terms of investing money for you. So contrarian doesn't mean that we would do a value fund or a contrarian fund. It just means this gives us an idea from a flow perspective where the money has been going and how that money has been performing, and does it warrant that level of premium, and do we pay that particular premium for our investors, right? So then this leads into second question and third question and fourth question, but I'm giving you an idea of what we usually look at, right? So what we usually look at has been telling us that we need to go more towards high quality and we need to go more towards large caps, and that is what we have been doing. But if we look at what happened, a lot of money has been going into, so people are chasing more and more trends, people are chasing more and more themes that have been hyped up on Twitter, on other platforms, YouTube. So we are very aware, and we would not take such calls for you, right? From I think we covered this, but if you still want me to spend some time on this, I would. It's in the unattractive zone, your small and mid. So we are not, our allocation towards it would be very prudent, right? So how has Neo been doing, right? Neo's investment framework is very simple. We have no cap on any particular asset class, so we can go 0 to 100 in any particular asset class. Debt 0 to 100, cash 0 to 100, precious metal 0 to 100, equity 0 to 100, global 0 to 100, right? And we have a top down and bottom up. So we do look at all these things, and then there's a bottom up approach that comes where we work with the research team. We have a very big team uh, on the research side. So we do a lot of top down and bottom up on all our asset classes, since we have exposure in all the asset classes, where only then we can take a particular decision. So we are concentrated across themes with a market leadership bias, right? So if you see here, most money has been going into which theme? Second question for all of you. Money has been going, right? 30,000 odd crores, 20,000 odd crores, 25,000. Where the money has been going? 12,000 this up until October. So where has this money been going? Second question follow. Right. So how do we maximize yield? So in the top down, we have an active strategy and a passive strategy. And in the bottom, it's an active strategy. So how does an active and a passive strategy sort of work when it comes to a PMS? See, when it comes to a PMS, our thought process has always been, and this is not related to PMS, even when we were doing the advisory service, is that a passive strategy should be a complement to the active strategy. So it has to be used very tactically, right? So for example, what we did in a passive sectoral ETF was we were very bullish on public sector as a space in 2018, particularly public sector banks where recapitalization had to happen. There's a lot of support that came in from the government, so we understood that yes, their balance sheets are getting much better. Write-offs would be there, so NPAs and gross NPAs would start coming down, right? So there was a very big buying period of 2 years. So it takes us some time to build our asset and build a very high conviction on it and keep acting on that particular conviction. So it went, this position went from 0 to 5, 5 to 7.5% of the portfolio, 7.5 to 12.5% of the portfolio. So there's no cap if you remember, right? But internally, we do not want to go beyond 10 unless and until there's a very big opportunity. And we got that very big opportunity. So usually there's a buying phase of a couple of years. It takes 1.5 to 2 years. And then there is a holding phase. Already we've been holding. Exit comes only when it reaches a certain valuation metric where we say that no, things are looking very expensive from here on, right? So our active strategy where we were going towards high quality companies on direct, we had our exposure towards ETFs where we understood that the entire basket will perform. So might as well take the basket rather than being choosy. So passive comes as a complement to the active strategy where we can afford to take a basket approach. We would take a basket approach. Right. So global, for example, we cannot take direct. So we are using a basket approach. Sectoral and thematic, we are using basket approaches, which is a complement to our existing active strategy for direct equity. Right. So bottom of course, will be active, but top down is the most interesting part about Neo because when we have a thematic idea, we only look at it from two aspects. Do we need to be very choosy and do we need to be very picky, just have a couple of names, or can we take the basket? Right. So we've been able to take baskets and we've been able to take, so in infrastructure, for example, we were taking, we were not taking the basket approach, we were taking the active, right? But for something that is extremely cheap, we were taking more passive. So we understand that, yeah, passive is important, but how you tactically position passive with your active strategy yields very high returns, and you would see how it has been yielding returns for us, right? So this had done very well for us. So how do we look at building portfolios? See, we want to, because we have that exposure towards debt and precious metals, naturally our portfolios will be versatile, right? And they would prosper in all markets. For example, when there's a high inflation scenario and high interest rate, their allocation for fixed income naturally would be higher, right? High growth, high earnings re-rating, your equity performs. So we do have that exposure towards equity, right? And we believe that multi-asset gives options to people to take advantage of all asset classes, and all asset classes need to be taken advantage of as an investor, right? If you see here already, flows into multi-asset allocations have been very strong. And if you look at it from a 19 all the way up until 22 or 21, flows had not been very high. But if you see now, the flows have been very good. So everybody is agreeing to the part that yes, it gets very difficult to take active bets on small, mid, and then large. Timing cycles also investors cannot do. So better to give it to a fund manager who's able to do all of this by having a multi-asset approach. Basically protect you when things are bad and also give you more returns when things are good. So it's a win-win for everybody. Right. So our entire endeavor is to build versatile portfolios that prosper in all markets. Right. Now, if you see how we've been able to do that, if you see Neo in the last 1 month, the drawdowns have been lower than that of the multi-asset index plus Nifty 50. See down. Right? If you see from a 3 month perspective, we've done phenomenally. But I would say always look at it from a perspective of uh, 5 years plus, 6 years plus is what I would say. So since inception, we have been able to outperform indices, but our endeavor is to create portfolios that during a bad phase, even with a higher allocation towards equity, should be able to protect you and have a lower downside, right? And our downsides or have been somewhere around since inception has been somewhere around 4%, where the index, the multi-asset index is 5 and Nifty is 10. Right. So our endeavor itself is to create versatile portfolios that can protect you as well as perform very well. Right. And that particular model has been working out very well. This is not a model that we created 2 years back. This is a model that we used to run for the advisory service since 2013. That has morphed into a very good a PMS where everybody can sort of take advantage of. Easier, fees are low. From an execution standpoint, it's much better. There's transparency, there's a lot of ease, and there's a lot of accessibility. Right, so we opened up, and whoever has come on board with us has benefited very well. It's the same strategy that we're doing on the Indian multi-asset called Sphere. It's just that on this particular product, you will not have mutual funds because it is very difficult to do mutual funds on this particular product. But on the Indian multi-asset part, we will be able to do very well. Right, so it's the same philosophy, same strategy, but that one will not have this one will not have mutual funds, and that one will can take exposures on the mutual fund front. Right, so from a performance perspective, if you see on a long-term basis, since inception we've done very well, but that's not something that I wanted to look at. I wanted to look at our current exposures now. Equities has somewhere around 73%, cash is 8, global is 4, and precious metals is a heavy 16, 17%. Right? And this is our overall allocation. But when assuming that yes, you say yes, I do, want to look at Neo seriously as a particular product, it on that day, whatever the opportunities are, it depends on that. So for example, today, like I said, we take some time, right? We take some time. So at today, our equity exposure is somewhere around 35 to 40%. That's it. Right? Everything else is an alternates, and everything else depends on opportunities. Our scale up also takes place based on opportunities only. Right. So our entire skill as fund managers gets uh, tested and again gets displayed. Right. So as an overall fund allocation, our current allocation is 73% towards equity, right? So now if you look at the return perspective, it will look, yes, 28%, 28.5% since its inception in 2022 is very, very, very high. But our expectation, like I said, we want to operate in a part where we are being very conservative in terms of what we want to buy, but aggressive in terms of how much we want to buy, right? And since it gives us that option of moving laterally between asset classes, it becomes easier for us to be conservative and aggressive at the same time in terms of how much we want to buy, right? So our expectation is that we are operating with an average inflation plus 5 to 7 sort of uh, expectation in terms of how much an investor who partners with us can make from a sustainable basis, right? Last 2 3 years has been very good, so don't have that expectation that it will do as much as this. Our expectation is somewhere between 12 to 15%. That's it. Right? That's what we want. If you're able to sustainably grow between this level, then your money doubles. Sort of, I think the math is somewhere around 6.5 to 7 years. Right? If we are able to deliver high, then 6 months off, right, at every percentage. So this is what our expectation is when we are building portfolios for you. Sustainability and versatility is what we are uh, looking to promise to you. Right. If you look at it from a minimum investment, I think PMS 50 lakhs is the minimum. Fees is 1.5%. This is on the net asset. So let's say 50 becomes 75 on the 75, which is charged to you quarterly. So nothing comes out of your pocket. Our dividend yield itself covers up most of the fees. It's somewhere around 1.3%, 1.35%. So it covers up for the fee. You don't have to pay anything to us. Everything will be taken from the portfolio. All the growth is yours. There's no profit sharing model here. Right, the ideal time for an investor is somewhere between 5 to 7 years, and there is no exit load in this particular product. Right, like I was telling you in the beginning, the team is large. The team is very good. We have a very strong roster of research and strategy. I'm part of the strategy part, and I'm on the team that manages Neo and Sphere, which is the multi-asset dynamic asset allocation sort of product where we can there's no cap, 0 to 100, right? The Sphere is for Indian investors and Neo is for non-resident names. Okay. I think now I'll open the floor for Q&A. And my apologies if I went too fast or I kept you bored, but there was a lot of data in this particular presentation. So you can put your Q&A in the chat box, in the Q&A section. I don't know, wherever you can. Yes, there's a comment saying valuations are high right now. How will Japan do? There's no growth in Japan. Whatever hype came in the middle, people wanted to go because the inflation started to go up, and naturally, they have not seen that level of inflation in years, decades. So when that came in, you saw corporate profitability also go up. Whatever came, re-rating came on that part. But like I said, currency, given that Trump is there, and he's been very vocal about what he wants to do, and you know, the tariffs and how making US competitive becomes a very big focus. We have to see how that sort of takes place. Whatever growth has come from Japan has come from an inflation perspective. They've never seen that. What was the answer for how much percentage of stocks have outperformed Max 7? I didn't say, you have to tell me the answer. Two questions, huh? Or forget the world, even if you can tell India, that's good. Because I have the number, it's in front of me. Oh, what time frame? 2024. Take 2024. No need to see this year. Maybe less than 5%. You're wrong by a big margin. Because the assumption is that US does very well. We should do only Max 7, great companies, pay whatever premium you want for that particular business. Don't think of any fundamental logic, nothing. Just buy and leave it. BAP. That's what they say, right? Buy at any price. But you're off by a very big margin, yeah. Globally, the number is 15%. 15% of companies are in better than Max 7. So you think of India. Okay, there's a comment. Very interesting. Is Neo and Sphere one in the same category, same portfolio? Not same portfolio. It's different because you there are certain restrictions for non-resident Indians which we cannot do. So its philosophy framework is the same, uh, but the allocation towards certain businesses would be higher. It would slightly be on more aggressive side when it comes to Sphere, because Sphere can take some mutual funds on the debt category. It becomes difficult to do on passive, debt. So uh, category is the same, philosophy framework is the same, that we want to do this, but that particular portfolio from a position sizing is run differently. Thank you. Thank you so much for joining. I'll keep the floor open for a couple of more minutes if there are questions. Uh, then please do send us a hi on this number. Somebody from the team will get in touch with you. Uh, if you're interested in the Neo product, I can have a one-on-one conversation with you, if not Neo Sphere as well. And I can share a lot more data than what I can do publicly. The minimum investment for Sphere is 50 lakhs. So both Neo and since it's a PMS, SEBI registered mandate is 50 lakhs. So 50 lakhs for one product. Thank you. I don't think there are further questions coming in. So I think we can close. Thank you all for joining in. Have a great weekend ahead. I'll see you again next week. Thank you.